Good evening. It's Wednesday, May 28th, 2014, and this is the Hidden Pivot / Camouflage Trading webinar. The course consists of 6-hour-long segments, and we're going to try to get to some real TradeStation charts in perhaps the final 30 to 60 minutes of tomorrow night's class. And you have the option. Sometimes people come to this course from difficult time zones. If you're in Europe, this course happens in the middle of your night, but even if you fall asleep, there'll be little lost since the recording will capture the webinar in its entirety. I'll say first off that I truly enjoy teaching this course, because for many students it represents kind of they're embarking on a new phase in their trading lives. I like to be thought of as the guy where the buck stops, and I know that many people have come to the course with some knowledge of other trading systems, but I'm just assuming that because they're here, those courses didn't really help them much. The course that I am going to teach involves a method that I have refined over the last 15 or so years, and the system is very much my own. I call it the Hidden Pivot method, and you'll see why shortly. But over the last couple of years, there has been increasing emphasis on a technique that I call camouflage, that will incorporate the rules and tricks that you're going to learn up to that point. So we'll get into camouflage sometime around the middle of tomorrow evening session. But by the time we get there, you will already know about 90% of the things that you're going to need to know to use that particular trading tactic. I did mention before I switched the recording on that the course mutates somewhat from one month to the next, not only because I learn things myself between courses, but also because the personalities of some of the vehicles that we trade are constantly changing, and there's been a somewhat pronounced shift over the last several months that makes it more difficult to trade, in particular the E-mini S&Ps, but we're going to see what steps are possible to get around the changing personalities of these trading vehicles. And of course they change simply because there are more players, the algorithms that they use to trade, and that's largely what comprises trading these days. It's mathematical formulas being applied to automated trades. So to the extent that everybody's an algorithm trader these days, it causes the trading vehicles themselves to change their behavior. So without further ado, we're going to get into the course material. And again, as I mentioned, this is all going to be recorded, so in theory you could fall asleep. A bit warm today, so I've opened my office window, and we have an airport not too far from here that I hope is not too busy this evening. But if you hear a little background noise, it's because I'm just trying to get a little ventilation in my office. The PowerPoint slides that you'll see correspond to the pages in the hard copy manual that you will likely have received by now. You've been dealing mainly with my wife Marilyn, who administers the course, and I'm hoping that everybody who comes into the class is prepared. When you have imbibe the rules of the Hidden Pivot method, you're going to find that they will allow you to trade any vehicle from the long or short side, and that means not only gypsum wallboard contracts on the 1-minute bar chart, but you can trade the weekly chart of IBM shares or of a mini index futures contract. But there's no distinction really as far as I'm concerned. These vehicles that we trade and forecast are simply dots that move up and down on charts. Another thing you'll be able to do is identify the trends with precision and confidence. And if someone were to ask you, what do you think of IBM here, or what do you think of the industrial average, the reply, strictly speaking, from a hidden pivot perspective is, well, what time frame are you talking about? And you'll discover that when we are looking at, for instance, an uptrend on the 5-minute chart, that it could very well be and almost invariably is part of a downtrend of a larger pattern, which in turn is within an even larger uptrending pattern. We've been in a bull market since 2009 for stocks, and the result is that the dominant trend is bullish. So if we're trading on a particular day and we're looking at a downtrend, it's in a lesser time frame. Sometimes I drum roll the targets that we use for trading purposes, and I know there's always a bit of suspense as to whether I will hit the target exactly or miss by a tick or two. But one fact that tends to get overlooked when these targets are drum rolled is that I've gotten the trend right. So the other day when I put out an E-mini S&P tout, and the E-mini S&P was trading somewhere around, I think, 1898, I suggested shorting it at 1914, 16 points above. And the trick there was not only in nailing the high, we did get the high, the exact hidden pivot where I'd suggested shorting was 1913.50, and I suggested also a 3-tick stop loss, a stop loss at 1914 and a quarter, and we got a high at exactly 1914. So I was able to hit the top with pinpoint precision. But little noticed in that forecast was that I got the trend right. It could easily have gone down just as easily have gone down as up, but in getting the rally target, I also correctly forecast the trend, which was a rally. This next item, managing risk tightly with camouflage, you'll see how it's possible to very tightly control the risk on entering a trade. And for most traders, the hardest part is getting on board, although managing the risk of a trade when it's in motion has its own particular challenges. But you'll see that with a very, very simple idea that involves something I call an impulse leg, you're going to have a new risk management tool that I would warrant is going to be worth the price of the course. Just this one little trick is something I could teach you in 5 minutes, but I'm going to wait till we have it in proper context before I mention it, but just keep that in mind. We also have ways of using these hidden pivot targets to do options trades, to, for instance, buy puts when a stock is hitting a rally target, or to buy calls when it's hitting a correction, a targeted low. And you'll see there's a way of using options that helps us to build edge into a trade. I don't recommend that everyone just go out and start buying puts and calls, and I'll mention that I've been at it for 40 years. I've had quite a bit of experience trading options, not only on the Pacific Exchange floor as a market maker, but as a professional, and sometimes as, I guess, an amateur, someone trading from his home, just as you would be doing. But trust me, it takes every trick that I've learned about options over 40 years just to have a moderate, a small positive expectation, to have the expectation of making at least a small profit on average in each option trade that I do. So it takes everything that I know to get there, and we can't afford to give up any edge in these trades. But I'm going to show you a very simple way to, for one, determine a good, fair price at which you should buy an option if the underlying vehicle is at a hidden pivot reversal point. We're also going to look at a type of trade that allows you to be done your workday after relatively little work, and you'll see that the hidden pivot method is ideally suited to identifying swing points and tradable reversals at times and in places where most other traders are in a pretty freaky state of mind. We thrive on panic and fear because we don't really get immersed in the emotional side of it. We're simply looking at its manifestations up and down on a chart in terms of what they are impulsively, or what kind of impulse legs all that panic and fear forms on a chart. And mainly, this will apply in most of our trades. We're going to be looking to get into a trade in places where the herd is simply not there. And one of the reasons that I call hidden pivots is that they represent technically derived price reversal points that are not generally apprehended by other technicians. I won't say that they're unique or that we are uniquely aware of these reversal points, because there are always going to be other ways that they can be gotten at, and I'm especially respectful toward Elliott wave theory because it's capable of great accuracy in finding these reversal points. I've had the hidden pivot method described as Elliott wave theory in three-wave structures, and that's not exactly correct, but I will say that the method of analysis that I teach is capable of the same accuracy that you would derive from Elliott wave analysis, but I believe my method is quite a bit easier to learn. I can't tell you exactly why these hidden pivots work. I've watched them play out on charts literally hundreds of thousands of times over the years, and I would only say that when you're looking at a stock go up and down on a chart, that over time the movement up and down comes into balance. There's a kind of yin-yang energy in a chart. You might liken that to the action of inhaling and exhaling, and obviously you can't inhale without exhaling at some point. Visually speaking, this process of inhale and exhale is analogous to jiggles and jaggles that you find on the chart. And by and large, the task of finding good tradable ABCD patterns will entail matching up visually corresponding pairs of jiggles and jaggles. So you're going to see that over and over again. I did begin this trek of mine developing and honing a trading system as an English major. I'm not a mathematician or an engineer, and so the skill set that I brought to sharpening the hidden pivot method is largely right brain, if you believe that the left and right hemispheres are adept at specialized functions. So in any case, I'm what they used to call a right brain guy, and so the method that I teach is mainly visual. It wasn't always that way. I used to teach it the way I thought students would want to learn it, with a bit more math, but over time I've come to teach the hidden pivot method more and more the way I learned it. So your learning curve will track my instinctual curve to some degree. I did say that Elliott wave theory can be very complicated. This is a chart that has been annotated for Elliott wave price movement, and the problem with Elliott wave theory is that there are literally dozens of corrective patterns, and it can be very hard to separate one out from the other. When we do the analysis, We're only using patterns in different time frames that will be quite a bit more obvious than some of these Elliott wave impulse moves and corrections. I use the word impulse here to denote a new trend, and one of the very keen similarities between hidden pivoters and Elliott wave traders, Elliott wave analysts, is that we agree on the difference between price action that's merely corrective and price action that is impulsive. So you'll see what I mean by that further down the road, but there's a very significant piece of overlap there between Elliott wave theory and the hidden pivot method. I'm going to show you a couple simple patterns. This is the basis for all of the analysis that we do. The hidden pivot method uses an ABCD pattern that looks just like this one. It can be flipped upside down, and anything that I say in the course of this webinar about a rally would apply to a downtrend in the same way. So we'll be looking at patterns that are going up and down. I think most of them are probably up, but the same rules apply in downtrending ABCDs. The AB portion of this pattern is what I call the impulse leg, and it should look relatively distinctive in comparison to up and down price action on a chart. The AB leg should look impulsive. It should look like an AB leg. It should look like something new, different, and even exciting is happening on the chart. BC here is a corrective leg. It is a kind of stop, in this case a consolidation, before this stock embarked on the CD leg, the follow-through leg. So this is the basic ABCD pattern, and you'll find that it is fundamental to all of the forecasting and trading that we do. I've broken that BC leg down as though we were looking at it with the magnifying glass, and you'll see that when we look closer at BC, that it takes on its own ABCD characteristics. Generally speaking, I will show the dominant trend with uppercased ABCD and the corrective trends against it with lowercase ABCD. And you'll see that it's not always perfectly clear as to whether I should label something with an uppercase or a lowercase A, B, C, D, but that's not a very important concern, and it's not very difficult. You'll see why in a bit. I've added one bit of information on this chart, P. P, very simply, is the midpoint of that CD leg. Here's an ABCD pattern on a chart that has prices, and you'll see that in the end the length of AB was equal to CD. We had a $7 rally from A to B, and the same $7 interval repeated itself in getting from C to D. We're going to spend a little bit of time on this chart. This is a summary of Lindsay's Trident. Lindsay's Trident was a technical method that was taught in the early 70s. The author was a fellow named Charles Lindsay, and he teamed up with someone whose name may be familiar to you, Larry Williams. Larry Williams is a great teacher, and if you've ever been to a Larry Williams seminar, I know you would have come away from it pretty excited about the things that you'd learned. He's really a master, and he teamed up with Lindsay, and they offered a course on Lindsay's Trident. It was a one-day course, and it was pretty expensive. This was the early 70s, mind you, and I think the course was offered at $3,000. And the gimmick for marketing purposes was that you didn't have to pay for the course until you'd made some money using the ideas that it contained. And so let me take you through Lindsay's pattern. It's the same ABCD that we use. I've labeled D as T, target, but typically we'll use D. And a couple other price points. X is the point along this ABCD pattern where you would get long. P, as you're aware, is the midpoint of the CD leg, and D is the target. How do we get that target? Well, again, we're looking for that ideal situation where the length of CD is equal to AB. And in this case, we had a $30 rally for the AB segment. And by the time CD had played out, it was a $30 rally as well. Now, the way Lindsay's method worked was that you would have, if we look at this XYZ stock is coming down, 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 when it's down here and it starts to rally, visually we are given to expect that it's going to take another leg down. But in this case it didn't. It kept on going and going and going, and by the time it got up here, we began to realize that something different was going on, something new and interesting, and that came from the fact that we've got a rally that surpassed one of the old peaks right there. And by the time it got up to here, we definitely knew there was something new and different and exciting going on in the chart relative to this chopping price movement downward. So this is your impulse leg, and I hope that the word impulse leg, or those words, describe in your mind something that accords with the idea of impulsiveness. It's something new and different. Lindsay's pattern allowed for that BC pullback. And how do we know how much it can pull back before we can say that the AB impulse leg has been ended? If it pulled back to here and then started up again, would we call that B and that C? According to Lindsay's rule, we needed for the impulse leg to pull back at least 0.618 of this distance here. This is a 15 point, what I call a KA segment. And to get KA, we simply, if we're looking at an AB impulse leg, we work backwards and find the first little stick up high that precedes it. So this last little segment, this is the last piece of price movement that occurred before this thing went bullishly impulsive going the other way. So in order to know how much of a drop back, a fallback, we need to see before we officially call the impulse leg ended, Lindsay's simple rule was, well, if we're going up, 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 if we get a correction equal to at least 0.618 of this KA segment, and just to use a calculator, if we take 0.618 times the KA segment here is 15 bucks, 95 down to 80. So we multiply 0.618 times 15, and we get the number 9.27. And so Lindsay was saying that if we have this rally and we have a correction that's at least $9.27, then that officially ends the impulse leg, and we are in what Lindsay called the window. In other words, we're correcting. This thing is taking a breather so that it can get recharged for another leg up, a CD follow-through leg. So to put it another way, and let me actually draw the window line here. All right, so Lindsay's idea was that, excuse me, let me get back to that slide, was that we've got this rally. The rally is officially ended when the impulse leg is ended when we get a pullback of $9.27 in this instance, or 0.618 of this KA segment. So now we're in the window, and when we're in the window below that W line, it implies that this XYZ stock is sufficiently recharged to take another leg up, to take its CD follow-through leg. And I want you to notice that we really don't know to call that point B until we pulled back into the window. And one further idea within this Lindsay Trident method is the question of when do we know that we've made a low, a point C, and we're embarking on the CD leg, that this thing is off the launching pad. Well, Lindsay's very simple idea was to take 25% of this AB leg, in other words, $7.50, and add it to whatever low we have that occurs in the window. And if we get that rally of $7.50, again, that's 25% of this AB leg, then it triggers a long. We get long at point X. And you can see it didn't quite happen here. We pulled back into the window, so we're essentially cocked and reloaded for a CD leg. But the first rally didn't go quite 7.5 points. It didn't go 25% of this AB leg. It only went $5. It slid back and made another low, and it starts to rally, and lo and behold, it gets up to that $100 mark. It's a $7.50 rally. Again, that's 25% of AB. And when you add it to a low in the window, made it 92.5, it said get long at 100. And I want you to notice as well that just as we didn't really have the wherewithal to label that point B until we had a pullback that got us in the window, point C does not come to exist until we've got a rally from some low in the window that's equal to at least 25% of this AB leg. So we get that here. And Lindsay's advice at that point, we're long, let's say 400 shares. And his advice was to put a stop loss just below 92.5, just below what became our point C low right there. And let me stop here because I don't want to use any terms that you might not be familiar with, but do you understand what a stop loss is? You can just type that in the Q&A panel, but if you'd like me to explain the principle of a stop loss, I'd be happy to do that. Okay, so you do know. So moving on, Lindsay gets long here. He puts a stop loss just below point C, and then lo and behold, he gets a rally. It goes up, 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 up. And Lindsay's idea at that point was that if he's got a decent profit right here, he doesn't want to subject it to a total loss that would occur if this thing slid all the way back below C. So Lindsay suggested that when you get to P, the midpoint of that CD leg, and that's calculated simply by adding half of AB, 15 points, to the point C low, 92.5, so you get a P, what Lindsay called the critical price, of 107.5. It was there that he would implement a trailing stop. And again, I will be happy to explain the concept of a trailing stop if you'd like me to. All right, so I'm assuming that you're familiar with the idea of a trailing stop. All right, so Lindsay would get long here, and he would implement a trailing stop right there to protect his profits up to that point from a slide all the way back down to C. And how did Lindsay determine the size of the trailing stop? He simply took 25% of the differential between B and C. So that is a 17.5 point differential, 17.5. And if we take 0.25, 25% of that, we see the number is $4.38. I'm going to round it to 4 just to make this example easier. But again, he's long here, and when he gets halfway along that calculated CD leg, he implements a trailing stop of $4. And at this point, I'm going to introduce an idea of my own. I like to keep risk and reward in a 1-to-3 relationship in all of the trades that I do, from the time I enter the trade till the time I exit it. So in this case, this shrinking or dynamic trailing stop would be calculated as follows. You're in here, you're long at 100, and you finally work your way up to 120, let's say 121. At that time, you only have $1.50 worth of profit potential. Your target all along has been 122.5, and if you're at 121, you've got another $1.50 to get to your price objective. And if you keep that 1 to 3 risk-reward relationship as paramount, it means that you should not suffer any more adversity than a 50-cent swing against you. So in other words, as this thing gets closer to the target, you shrink the $4 trailing stop that was acquired here according to how much distance you have to reach the target. So when you get up to 122, you know there's always the risk that this thing could drop 15 points without warning. So you want to protect those profits, and at that point, at 122, you should stop yourself out if this thing moves only 50 cents against you, or 1/3 of that distance between 121 and your profit objective 122. Now, if you're a little bit fuzzy on all of the things that I've just explained, I want to mention that the material that I've covered in the last 10 minutes was the entire sum and substance of the course taught by Larry Williams in the early 1970s. So I'm not quite sure what he did to fill up the day, because really I've given you everything that's contained in the book that Lindsay wrote called Lindsay's Trident, a Trading System, I think it was. And I've covered in 10 minutes the entire course content of the Larry Williams seminar. Now, we're going to see this pattern quite a bit, but before we leave it, I want to say something that is a bit disparaging about Lindsay's Trident, and that is that if you take the X entry point, most of the time you're going to lose money. And I want to show you why. We're going to look at this chart. We're going to go along the path of it, but in a psychological understanding of it each step of the way. And I want you to pretend that you don't see anything to the right of the cursor, that this pattern is playing out without your knowing that it eventually reached the D target. So we've got a little bit of an up movement, but at this point we only expect another downturn, because visually speaking, that's what these ratcheting down price patterns give us to infer. In this case, however, we got up to here, and by the time we're up here, we're thinking, geez, I wish I'd known how strong this thing was going to be, because I would have bought into it. But because we've got a quite substantial rally up before we even realize that we've got an impulse leg, your tendency at this point would be to say, well, I don't really want to buy it up here. I'd rather wait for a little bit of a rest. I want this thing to take a breather, in other words, to come down a bit before I buy it. But if you're a typical trader, you don't want to buy this thing while it's coming down, down, down. You want some evidence that the corrective, the BC phase, is over, and that it is embarking on a CD follow-through leg that represents essentially the potential that you felt when you witnessed this AB impulse leg. And a good strong impulse leg, in psychological terms, gives you to expect some sort of follow-through rally after a correction interval. So you wait for this thing to correct, and you'd rather have some sense that the correction is over before you jump on this, before you get long. And that sense is what you get from watching it rally up, 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 up. How much does it have to rally before you get this idea, well, the BC, you don't call it BC, but before you get the idea that the corrective phase is over? Well, you need for it to get about to here. Now, I say about because at the intuitive level, that's what many traders are thinking. They say, geez, I missed the rally. Let's wait till we get a little correction before I get long. and the idea that the correction is over will occur to most people somewhere around there. Even if they're not trading Lindsay's system or using ABCD patterns or anything else, at the psychological level, this point X of Lindsay's is instinctually the most enticing, attractive place to get long on the entire ABCD course of this stock. So that's the problem with Lindsay's Trident. The place where he tells you to be a buyer right there is instinctually the place where every Tom, Dick, and Harry wants to buy it as well. And you'll already know that if everybody does indeed buy right there, there are no more buyers to push this thing up in accordance with the expectations of all who are already on board. And it sinks like a stone. It stops everyone out just below point C. And then, of course, having made a second point C low, it's off to the races. But you're not aboard. So that is the key problem with Lindsay's Trident. It identifies an entry point that is too intuitively enticing to too many other traders. The other problem, which you may have surmised, is that along this entire 6-week journey here, 7-week journey, there's only one trade in Lindsay's book, and it's right here, get long. Well, you're going to find that the considerable modifications, adaptations, and evolution of Lindsay's Trident, as represented by the hidden pivot method, will give you ways to get long there and to do some covered rights up there and to start getting longer there, take some partial profits. There are literally scores of places where you could get in and out of trades if you analyze this chart in the hidden pivot way. But with Lindsay's method, it's very simply getting in there along with everyone else and watching it stop you out. To be fair to Lindsay, he developed this system in the early 1970s, which of course was long before we had the capability of sitting at our desks looking at price patterns unfold in real time on 1-minute bar charts. So when I took Lindsay's basic ideas and I watched them play out literally thousands of times, it steepened my learning curve. I was able to deduce quite a bit more from the ABCD pattern than Lindsay was. His method involved opening up the Wall Street Journal every day and using a marker, magic marker, to circle what he called ring highs and lows, which became A's, B's, C's, and D's. And of course, that's a very slow way to apprehend all of the unusual, the interesting capabilities of this ABCD pattern. One very crucial aspect that Lindsay never discovered was involved the P midpoint pivot. And I did bump into Larry Williams at a traders convention and expo in Dallas. It was called the TAG Conference. And I was there actually to recruit Larry onto the board of a company that put some very powerful trading systems online. The company was called Well Invested. And I sat him down for a few minutes and I explained to him some very interesting things that Lindsay had missed. And mainly that price action at P has an enormous amount of information in it. And depending on how a rally interacts with P on first contact with it, we can deduce certain things about the larger trend, the dominant bull trend here, and about what might happen thereafter. Strictly speaking, we don't have a crystal ball, but we do have a way to assess the odds that a dominant trend, a primary trend such as you see represented in uppercase ABCD, will continue. So I'm going to leave this chart, but you'll have the option of coming back to it at any point during the course. But you're going to see repetitive examples of this pattern so that I don't think you'll need to refer to Lindsay again. Before we leave it entirely, you'll see that there's one piece of it that I did not mention, R. R was Lindsay's reversal line, and the idea being that if you get a correction from that high down to a low that retraces more than 0.618 of the AB impulse leg, then there was no trade for Lindsay. He basically said if it pulls back that far, it's you're going to see that the CD leg will not fulfill its promise as reliably as it would if we didn't get such a serious pullback. I later found that assumption to be wrong, and so I don't have a reversal line to tell me when I should forego the trade. In fact, if we get a pullback all the way to here, as long as it's just a penny higher than our point A, then we have visually a pattern that can define an uptrend, A, B, C. So again, if C is just a penny higher, then we've got an uptrend that we can work with, and we can plug in those A, B, C variables to get the good stuff, the stuff we need to actually do the trade, namely the X entry point, the P midpoint pivot, and the D target. One further item I'm going to mention is that there are only two hidden pivots, P's and D's. And I've already explained why I call them hidden pivots. They are reversal points that are not evident or apparent to traders using other technical methods. So hidden pivots are always either a point P or a D, P being the midpoint of the CD leg. Here is just a further explication of the window idea. We've got a rally and we start to pull back. How do we calculate W? Well, once we have A and B, a nice looking impulse leg, we simply work backwards to get K, and we plug K, A, and B into our calculator, and it tells us that the window, the W line, will be the 0.618 of Ka subtracted from B. And we actually have a calculator for that purpose. If you did not receive one by email from Marilyn, just let her know, drop her an email tomorrow and say, please send me a nice hidden pivot calculator. Over the years, students have made dozens of these calculators for me, and this is a relatively simple one. You can see there's no magic in the calculator itself. The calculator does not make you money. It's not the holy grail of trading. It simply allows you to plug in coordinates to get some information that we use to trade. There are two types of calculations that we do. One, represented by this top spreadsheet, is the target calculation. And when we do a target calculation, we simply plug in A, B, and C. When would we be doing that? Well, if we're here, and we've got this nice rally, and we start to pull back a little bit, we can see that the rally has impulsiveness written all over it. It's got the kind of A-B-ishness that we're looking for. But we don't really get a point C until we pull back into the window and rally just a bit. So there are really a couple of places where I might think to use the calculator, where I might need to use it. One is we get a pullback and just a little bit of a rally. And as soon as we get that little bit of a rally, we start to see a possible A, B, C. We plug it in, A, B, and C. And it gives us X, the entry point. We get long at 1057. And just to remind you, we calculate that 1057 by simply taking 25% of the AB leg and adding it to our point C low. And we also get a P. P tells us that when we get long at X at 1057, right there, we stay long till here. I like to take half the position off, and even though, as you can see, that doesn't represent much of a partial profit, it's always good to take a small profit early in a trade. Let me ask you if you have ever been in a trade and it just seemed to it went against you, and you got a little bit nervous, and went against you some more, and you got even more nervous. And at some point you thought, well, I got to bail out here. This is just too bad. And you bail out, and it turns out you couldn't have bailed out at a worse price. You get out at the exact low before the thing takes off like a missile. Have you ever had that trade? All right. Well, I'm assuming you have. We all have. But there's another type of trade I'm sure you've experienced, and that is you get into it, and it goes your way, and you think this is great, and you take profit, and it goes your way some more, and you just sort of have the rhythm. You eventually wind up getting out at the top of the rally, and it felt like everything was right as rain. Have you ever been there? All right. Well, I'm assuming that yes, you've had both of those experiences. The best way I know to create that experience for yourself, to be in that comfort zone, to be almost like a stare dancing with Rogers, is to take a small profit early on in a trade. Nothing enhances your judgment so much, so well, as just having a little bit of the house's money in your pocket. So that's why I always suggest taking a partial profit. So my minor adaptation of Lindsay is I take half of my position off right there, and then I just ride him cowboy. It never did reach the target, but if you were using our dynamic trailing stop, you see we're up to, looks like 106.2 1/4. We're $1.50 from the target, which means that at that point there, we should have been ready to stop ourselves out on a move of just 2 or 3 ticks against us. All right, so that's how the calculator works. You plug in A, B, and C, which you would do around here. You might wait till the other instance where you would be inclined to plug in your A, B, and C would be in waiting till you actually hit X. Because keep in mind that the point C doesn't come to exist. We don't know that's a point C low until it's been defined by our trade entry right there. Actually, it would have come on this bar right here. All right, so we plug in A, B, and C somewhere around here or here or here or here. And it gives us X, the price where we get long. It gives us P, where we implement a trailing stop. It gives us the D target. SD is stop differential. That's the trailing stop. SD is simply 25% of the differential between B and C. And ED, entry differential, 2.25 points, is simply the 25% of this AB leg that you add to your point C low to give you your entry point. So that's what ED and SD mean. They may have been a little curious when you looked at this for the first time. So that's really our target calculation. The window calculation involves plugging in K, A, and B. And when would we do that? Well, when we get this nice impulsive rally and we start to pull back just a little bit, giving us the idea that, hey, maybe we've got a point B high right there, the terminus point of an impulse leg. So it pulls back a little bit there, and that's when we would be tempted to plug in K, A, and B. We know where A and B is. We just sort of work backwards to find a nice stick-up bar. We might have used that one too, but you're going to learn a bit down the road why that's not technically a high, a peak. All right, so we have, again, we plug in K, A, and B when we pull back to, let's say, here. And it tells us that our W line is 1056.63. That's simply taking 0.618 of this KA segment and subtracting it from our point B high right there. All right, so before I leave this slide, I'll just ask you if you have any questions at all about the calculator. It's pretty straightforward, but I just want you to understand that it's not the holy grail of trading. It's not something that says buy here, sell there, and make money. It just gives us some basic information. Here are some ABCD patterns drawn from the real world. We've got the E-mini S&Ps, a futures contract. And if I had stripped out the notations here and said, okay, find me an ABCD, I know that you would have a lot of difficulty coming up with it, and I very seriously doubt that you would have produced the same A, B, and C that I have. However, there's a very easy way to figure out where your A, B, and C are going to be, and you're going to learn that little trick in just a minute. Here is another ABCD pattern that is not in the least intuitive, but you can see that ultimately it worked. It gave us a D target that represented in the bigger picture a fairly important top. And in this case, using these price points, A, B, and C, the 42.82 hidden pivot D target that was predicted was exactly to the penny where this home builder stock peaked. Once more, we see an ABCD pattern that is not even the least bit intuitive, visually speaking. And one other thing you want to notice about this pattern is that the ultimate low exceeded the D target. And of course, you're going to be confronted with many, many instances when you're working these ABCD patterns of rallies or corrections that exceed their D targets. And you'll find that when that happens, that provides, even if it doesn't get us a trade, which it usually will, it has the ability to supply us with some very useful information that we can use to get into a trade or to forecast where things are headed. All right, here's that simple visual trick, and rather than read the text, I want you to see the picture. Well, okay, let's take it text first. The way we find these patterns is to, in the context of the big trend, where is the major visually obvious corrective phase of it? And once you've found that corrective piece of the visual puzzle, you simply work backwards to find yourself a point A. So let's see how that works in the real world. Here, the big picture, as you can see, is an uptrend in this chart of the Gold Bug Index, HUI. And you'll see that in the course of this uptrend, we're right here, we're on the last bar, and we would be asking ourselves at that time, how high can this go? And the answer to that question is, where's a good logical D target? So in order to get D, we know that we need the three coordinates A, B, C to plug into our calculator. So what do we use for A, B, and C? Well, again, our first big picture glance shows this stock to be in an uptrend. In that uptrend, what is, visually speaking, the major pullback against it? Well, from that high to that low. So that high and low become respectively points B and C, and then we slide backwards to find the first little, and it's pretty small here, you need a magnifying glass, but the first little bar that sticks down by itself, that's our A. Same idea here. This Apple chart shows, first of all, in the very biggest picture, an uptrend. And we're here in time. We want to know, how much more running room does this thing have before it bumps into a hidden pivot resistance, a D target. And in order to get that D target, we need A, B, and C price points. So along the way of the rally, we see that the visually most obvious pullback against it occurred from that high to that low. So we take those as B and C, and then we slide backwards and we find at the microscopic level here a little bar that sticks down all by itself, and we use that as a point A. It's not chiseled in stone. If this thing goes on to exceed the D target predicted by that A, we would simply infer the logical thing that we need to use a lower point A to create for ourselves a higher point D. This chart of Google, lower right hand corner, is a bit more complicated. It's more gnarly than the other two charts that we just looked at. But you can see, first of all, that it does reflect a downtrend. The major thing going on in this chart is that Google is going lower. And in the course of going lower, where is the major swing against that downtrend? Well, the answer, once again, is easy to come up with visually. The major swing against that downtrend went from that low to that high. So they become, respectively and automatically, our points B and C. And then we simply slide backwards to get ourselves an A. I'll have to admit that the one we used isn't exactly in our faces. It's not very distinctive. It's just a tiny little stick up of a few bars. But the fact that it sticks up at all makes it a peak that we can use as a point A. And I'll also point out that because this little teeny tiny stick up bar here is maybe a penny or two above that, we could have used that as our point A as well. We didn't, however, because in the bigger picture, we tend to think that the final D target down there is not going to be associated with something as wimpy as that little high there, but something more important, one of these major tops that occurred up here. We arbitrarily took the last one of them because it was from that high that Google stock finally slipped off the face of the earth. A couple more patterns. Let's look at two of these. You see in this chart of copper futures that it's pretty gnarly. We've got this big gap here, another gap there, and it's more like price dots rather than price bars. The trading is so thin. But putting all those things aside, we recognize, first of all, that copper is in a downtrend. And in that downtrend, what was the most visually obvious swing against it? Well, from that low right there to, well, it's not quite so obvious up here, and I would suggest that because we're using a system that wants to project swing prices to within 100th or 1,000th of a point even, that it behooves us to measure, to put our cursor on a few of these dots to make sure that we're getting the exact high. If one of them sticks up just a 10,000th of a point higher than all the others, that's the one you want to be using as your point C. Another thing I'll mention is that we treat gaps as non-existent. We simply fill in the gap with an imaginary price bar, but they pose no special obstacle for us, nor do they contain any particularly special or useful information. Gaps are something to be ignored. So with those couple things in mind, we've got our pattern B, C, and we simply work backwards. And the last teeny tiny little stick-up bar that occurred before this copper futures contract went over the falls was right there. I love buying on the D end there. I love speculating with a limit bid and a very tight stop loss when I see a pattern this gnarly, because there are, in fact, other traders who use ideas similar to ours to discern tradable patterns. But sometimes when the patterns get a little bit un-ABC-like, when they lose that intuitive visual feel of being ABC patterns, those are the ones we really like to jump on because we will not have as much competition on the D end. This one here is pretty gnarly as well, but for all its kookiness, you see that there is a downtrend going on in Amazon, and in that downtrend, the biggest swing against it was from that low to that high. So once again, those price points arbitrarily and mechanically become our B and C, and we simply work backwards, ignoring this gap as anything special, and we find a teeny tiny little stick-up bar there, and it's beautiful. This pattern is so unintuitively ABC-like that it gives us a D that I would bet the ranch on, and also a P, but we'll learn about that later. And we're going to come back to this slide after a 5-minute break because it segues into a blow up, but I want you to appreciate something in this chart at full at your leisure. So let me pause the recording here at exactly 1 hour,